So Cathie Wood has been a champion for new investors over the last couple of years with her smart wit, lavishingly good looks, and her eyes for seeking out a good disruptive innovation stock. It's no wonder this lady has become a phenomenon with new investors worldwide. Cathie Wood and ARK Invest absolutely knocked it out the park with their ARK funds in 2020, but so far in 2021, it's been pretty sideways, and I think I know why. Cathie Wood and ARK made a name for themselves when they first bought Tesla, way before anybody else thought this company was actually worth a penny. Since then, the funds have become very popular with new investors and also big hedge funds because they actually share their buys and sells on a daily basis. That's right, you can see what they are doing day by day in the ARK funds, which is definitely itself something very innovative. Given the crazy results of the ARK funds in 2020, dominating returns that the S&P 500 give, and Cathie Wood sharing the buys and sells on a daily basis, it's no wonder that Cathie Wood has become a sort of people's champion. But I feel there is a very dark cloud hanging over the ARK funds, and we're going to talk about my crazy findings in this video, because trust me, it's very damn scary. In this video, I'm going to address my serious concerns I have from just looking at ARK's top 20 holdings. Seriously, it is very scary for new investors and any investor who is looking at holding ARK, especially in the short term. But after the findings of this video, if you still do believe in Cathie Wood's plan and disruptive technology, that's completely fine. But I do genuinely feel a lot of investors are sort of getting into something that they do not fully understand, and my point is to really bring this risk home to you in this video. Now, as always, before we move on, if you could be ever so kind to touch up that like button until it turns blue, it will be greatly appreciated. And if you want to sign up on eToro via the link in the pinned comment, sign up, deposit, and make a trade, and you do indeed get lifetime access to our LWT eToro chat room, where I do from time to time share my own buys and sells as they happen. Now, Cathie, before we get into the slating that I found in this video, let's address some of the positives. The ARK funds themselves are looking at disruptive tech, so they're going to be crazy volatile. I do see some of these funds as being very high risk, but very high potential reward. And if that floats your boat and you're fully aware that that is what you're getting into, then fair play to you. But I feel Cathie Wood is sort of believing her own hype, and she does really do think that she is the next sort of Warren Buffett and that she's going to conquer the universe in terms of stock investing. And I have to be honest with you, I just don't see it happening. I see Cathie Wood at the moment leading new investors into her ETFs into oblivion. Honestly, the findings I've found here are very damn disturbing. I think the thing here is they are looking for companies that can eventually become the dominant force in their sector. A company a bit like Tesla, where they bought it when the market didn't even exist, and then Tesla becomes a reckoning force. And that is one of their key holdings I'm going to talk about in this video, but they're looking for the next one. But long story short, let's say you're looking for the next Microsoft, the next company that's going to come and change the game in that sector. The problem you've got is there can only be one or two Microsofts. There can only be one or two, maybe three or four kings or queens or whatever, monarchy you want to set up there. But there can only be a few of these in every sector. There can't be hundreds of them. And I think that's the problem. It's like looking for a golden needle in a massive haystack. For every Microsoft back in the day, there was hundreds of them trying to start up, but there can only be one, and the chances of you at home finding it are next to none. And Cathie might have a better chance of finding it because of experience and so on, and she has got a better track record, but nonetheless, there is still a huge chance that she will get 1 out of every 100 right. But still, the needle is there somewhere in that haystack, and maybe Cathie Wood can find it with a better chance of 1 in 100 and more like 1 in 50. But still, I really don't like those odds either. But sticking with some positives, probably the biggest positive with the ARK funds is that you can go online and you can find their daily buys and sells. You can see exactly what is going on in the ETF itself. Now, this is a huge advantage, for example, because if you bought an ETF like one I currently hold, which is 𝐶𝐄𝐄𝐄, which is a Chinese tech holding, you don't really know what they're adjusting inside the ETF. until they release their quarterly report. A lot of these ETFs don't share with you the data like ARK Innovation does. So if you want full transparency on a daily basis, that's one big tick in the box for Cathie Wood. And I think she's been very, like I said, innovative herself. And I think a lot of ETFs will adopt this in the future. So given this fact, I get why ARK is popular. And given the fact that she had crazy results in 2020 and she's a likable person, I fully get when she speaks, people can believe it. But if you just scratch it beneath the surface and look at the top 20 holdings over all the ETFs, it just screams danger. And what I mean by that is if you go onto YouTube, including my channel, people are telling you to regularly invest. And if you don't have time to pick stocks yourself, regularly invest into ETFs because it's a safer option. And it's not necessarily true, because when people say invest into ETFs, they're talking about investing into SPY, the SPY, which is basically a tracker for the S&P 500, or invest into the Dow, or an ETF that follows the Dow Jones. They don't mean invest into even ETFs I hold like 𝐃𝐂𝐂𝐄𝐄, which is dangerous and very volatile in the short term because it's a Chinese tech play. When YouTubers say regularly invest into ETFs, they are definitely not talking about ARK Innovation. It's definitely not a safe short-term bet. Long-term, maybe, potentially, we'll talk about that in a minute, but the point is they do not mean these ETFs. And I think a lot of new investors are mixing up that if I just buy this ETF every single month, eventually I'm going to be a billionaire. And it's probably not the case. Many new investors are actually in fact quite lazy, or they just don't have the time to do their research. So I get why ETFs are popular. But if you want safe, steady returns, again, I don't think ARK Invest is for you. And if you look at the last year, it's pretty much stagnant across the board. And that is reflected in their returns from 2021. We've had the market go up crazy amounts, but ARK has actually fell by the wayside. And that comes down to the crazy volatility they had in 2020. But this is where I feel a lot of investors are messing up, because they think that buying an ETF is adding diversification, which is true if you bought something like the SPY, which is buying the top 500 companies in the US. But if you're buying something like ARK, there is diversification by sector, I'll give you that, but not necessarily on the company financials or the way the company is even profitable. But let's have a little look at my findings. In this, we're going to address the top 20 stocks that ARK holds across all of its funds. And let me tell you, I'm going to keep it very basic because I think a lot of people watching this video would A, prefer it, and B, it's quite easy to see the problem I have. We're going to address a few key features. First thing is the weight. How much of this stock ARK holds in its portfolio? For example, they have 7% of all of their cash in one stock, which is Tesla. We're then going to look at something called a PE ratio, price to earnings ratio, and the reason being is this is the very basic and simple and worldwide metric to determine whether a company is valuable in the simple, basic manner. Now, the simple way a PE ratio works is the closer to the number one, in theory, the better value a company is. Now, typically speaking, the S&P is trading around about 20 PE. So anywhere around 20, you could argue this company is fair valued, or even in some cases, undervalued. So ideally, around 20 is sort of a ticking the box. We're then going to look at one very simple metric. Is the company profitable, yes or no? And then the biggest one, dilution. Now, why is dilution important? We always use this example. Let's say you have 10 shares on the market, okay? And you own one of them. You own 10% of the total of this company. Now, if this company sort of sells another 10 shares at the market, that means they've got 20 shares in the market, but you only still own one. So your 10% stake has now fell to a 5% stake, which means the company is taking away your profit share of this company. A lot of people think dilution is okay in growing companies, which I understand. The way dilution works is they sell 10 shares at $1, they make $10, and it's a way to fund new projects, acquire new companies, or pay off debt. I understand why dilution is needed, but that definitely does not mean this company is in a good financial stead. I mean, think about it. They need to raise capital because they're not making money or enough money on selling their actual bloody product. Dilution is not good for shareholders. Don't think it is. Do not make that mistake. So looking at the findings right off the bat, profitability. Only 9 of the top 20 companies in one of the biggest known ETFs on the planet only 9 of them, less than 50%, are currently profitable. That is nothing short of horrific. Now, if we were talking about the lower 20 holdings or something like that, fair enough. But we're not. We're talking about the top 20 companies. 60+% of ARK's whole portfolio, 9 of them are profitable. It's horrific. There's no other way of saying it. It's absolutely horrific. And to think that this is still a safe ETF, even at this simple criteria, is ludicrous. Now, looking at the PE ratio, here's where it gets interesting, because you cannot calculate a price to earnings ratio if the company doesn't have bloody earnings. So we can only calculate a PE ratio on 9 of the 20, because 9 of them are profitable. And if we get the average PE ratio, again, 20 is sort of the market average, closer to 1 the better value, it's not good. We can see that it's 144.6 at the recording of this video. That's the average PE ratio of the profitable companies in the top 20 holdings at ARK. Quite a mouthful, I know, but let's just put it this way. It's very overvalued. The companies that are actually making money in their holdings are extremely overvalued. In fact, if we use 20 as the baseline metric, there is only one company in the top 20 holdings that is profitable and under 20 in a PE ratio, and that is CRSP, which again is not good because of dilution. And this is why I don't even think this company is a good buy. If we look at the dilution of CRSP, they have more than doubled their float. They have added an extra 101% at the recording of this video to their share count. So that means if you owned 10% of the company initially, congrats, you now own less than 5%. Thanks very much. If we look at CRSP, they used to have 39.9 million shares and now they have 80.45 outstanding. Now, on the dilution, I do want to clarify here, that is also including shares that have not been sold but are ready to be sold when we're looking at the numbers for these companies. But in reality terms, it doesn't even matter that much as a whole, because if we look at the dilution, how many out of these 20 amazing companies, these innovative genius companies that are going to change the world and their sectors forever, do you think are rewarding shareholders by buying back shares? None. That's right, I can't even keep suspense. Not one of these companies is buying back shares because most of them can't afford to. They're still in the growth stage and are diluting heavily into investors. Now, I just told you that CRSP, which equates to 2% of ARK's total holdings, has more than doubled its float, which is horrific. In itself, it's horrific. But it's only 2% of ARK. But if we move up the list and we look at the second biggest holding, TDOC, TDOC, we can see that this is 5.72% of ARK's total holdings, and it's horrific as well. They have diluted investors an extra 185%. Now, to be clear, this is an extra 185%. In 2017, they had 54 million shares on the market, and now they have 156 million. So if you bought TDOC, basically in 2017, you now have, well, shot yourself in the foot because you've lost 2/3 of your market share of this company. Now, some people will be thinking, yeah, but the stock price went up and yada, yada, yada. But ultimately, $1 in revenue is $1 in revenue. And that's what the long-term goal of any company or any investment should equate to. Another one, if we look at PATH, PATH, which is 3% of ARK's total holdings, they have also done the good thing and diluted investors an extra 144%, 215 million to 526 million shares. Now, why is this important? Why are these findings important, and what is the real kicker here? Well, the thing is, I feel Cathie Wood and ARK Invest is sort of a champion of the people because of, well, again, she's a likable person. She's definitely a clever investor. I'm going to give her that. But I want to clarify, the ARK funds are not low risk. They're extremely high risk and potentially high reward. You have to sort of make that assumption because of the findings I've just told you. There is no way in hell you can deem ARK Invest to be a good value play, a good long-term play, a good short-term play, because they are extremely high-risk stocks that they are investing in and continue to invest in. And the way I genuinely see it here is Cathie Wood is trying to find the next Tesla, the next company that is going to push her funds, her ETFs, into the stratosphere. And the thing is, Tesla is sort of a unicorn for Cathie, even though she continues to buy it at crazy prices, but it's a bit of a unicorn. And I feel that she is doing anything she can to try and find that next Tesla, when reality is we are due a correction. We're gonna have a crash at some point in the future. The world is in a very bad way, even if we don't want to admit it, and money needs to be paid back. Interest rates are gonna go up soon, and I think a correction will come. And the companies historically that get hurt the most in these corrections are companies that have high debt, low cash reserves, low cash flows, and these companies are pretty much ticking all these boxes, and they will have to dilute you to raise capital again, which in turn will push the stock price even further down. From the fact that ETFs that are more stable than Cathie Woods and hedge funds will be looking to lower risk in a correction scenario, again, these stocks will get hit very, very hard, and I just don't want to see investors get hurt as well. Now, if you are looking at buying ARK and regularly buying into it and holding on to it for 15 years, then who knows? It could work. It really could work. But I think as it stands, Cathie has sort of believed her own hype because of Tesla, because she was right one time, and now she's looking to find the next Tesla. But even so, you've got to question some of the tickers in this top 20. Twitter is not really an innovative stock. Far from it. Spotify? Well, no, because it's already an established industry. I don't see these companies being innovative at all. I can't understand why you would buy Twitter over Facebook. I can't. Look at the cash revenues, look at the growth, look at the cash flows. Twitter, if anything, is slowly dying. Now again, if you're rolling the dice, best of luck to you. I hope it does work out. I hope I'm wrong. I want everybody to make money. I just want people to see what this fund is. High risk with potential high rewards. If you want to see what value stocks actually look like, you can check out that video up there, or you can join Patreon and our chat room, or even my WhatsApp group, and you can get live alerts on what stocks I'm buying and selling. So if that floats your boat, check out the description. That's it from me. Peace.